Hello, thank you for tuning in to the Waterfront Equity Strategy Update. My name is Matt Hekman, and I manage the Waterfront Equity Strategy here at Waterfront Asset Management. As a brief reminder, the Waterfront Equity Strategy has an objective of capital appreciation. And the strategy has just over 2 years, or it just celebrated its 2-year anniversary. The initial investment was done on November 16th of 2021. And the investment philosophy is focused on investing in profitable companies, trading at reasonable valuations. The strategy has had a successful 2 years. If you go to the next slide, you'll see that its performance through October 31st, since its inception, while negative, down 2%, has outperformed the S&P 500, which is the fund's benchmark. However, you also notice toward the left-hand side of that slide that both on a year-to-date basis and a 1-year basis, the strategy has underperformed its benchmark and its peers in the Morningstar Large Blend category. So I wanted to take this opportunity to help explain why. On the next slide, you'll see that same graphic with the performance of the strategy through October 31st. And on the bottom left-hand side of the slide, you'll see the S&P 500 index return on a year-to-date basis, both as a capitalization weighted return, which is up 11%, as was mentioned earlier, as well as on an equal weighted basis, which you'll see the average stock in effect in the S&P 500 is actually flat on a year-to-date basis. The spread between the cap weighted return and the equal weighted return is extremely unusual and is at a level that we haven't seen in over 20 years. And the driver of that is depicted in that middle graphic right to the right of the slide we were just discussing. And you'll see on there year-to-date performance of a variety of cohorts within the S&P 500. So you'll see that large cap value stocks in the S&P 500 on a year-to-date basis are down a little over 1%. Mid-cap value stocks are down over 4%, and small cap value stocks are down over 6% on a year-to-date basis. On the opposite end of the spectrum, large caps, so big companies, growthy companies are up over 23%. And you can see, just looking on that graphic, that investors increasingly throughout the year have focused on a small group of stocks and driven those stocks up. And that's what's driving the performance of the cap-weighted S&P 500. If you peel the onion back another layer, on the right-hand side of this chart, we look at those same cohorts of stocks, but instead of looking at their year-to-date performance, look at their current valuation using price to earnings multiples, as well as their 20-year average PE multiple. So you can see large cap value stocks today are trading at a 13.1 PE multiple, and that compares over the last 20 years to an average multiple of 13.7. Now that graphic is pretty busy, and I think it's probably more helpful to look at the bottom half of that chart, which shows the current valuation, the current PE multiple as a percentage of the 20-year PE multiple. And what you see is investors are increasingly flocking to the biggest companies with the best growth characteristics, and they seem almost indifferent to valuation. Those stocks are trading at over a 25% premium to their trailing 20-year average price to earnings multiple. And investors are increasingly avoiding or moving away from anything in the small, mid, value, and blend category. And I want to remind you of where we started at the beginning of this video. This strategy, the Waterfront Equity Strategy, invests in profitable companies trading at reasonable valuations. And as a result, it's underweight these big companies that are trading at high multiples, which are driving all of the return in the S&P 500. Before we move to the next slide, I want to make one other observation on this chart. As investors increasingly focus on the small cohort of companies and avoid the rest of the market, it is creating opportunities No one knows. I don't know. No one knows when that opportunity will come to fruition. But I simply want to highlight there that increasingly in the market today, there is a pretty attractive risk reward in some of these areas of the market that today investors have largely avoided. So as we move to the next slide, that will help highlight the current and explain the current positioning of the Waterfront Equity composite of separately managed accounts. And you'll see in the pie chart on the right-hand side that the strategy is very well diversified across sectors. And the top 10 holdings, which are shown at the bottom, will highlight the fact that my largest position is in Treasury bills with an 11% weight. And the reason for that is because my outlook for economic growth suggests that not only will economic growth continue to slow, I expect it to turn negative at some point over the next 6 to 12 months. I think the current forecast of corporate revenue and earnings for the back half or the last quarter of 2023, and then the full year of 2024, I think those estimates are likely to prove optimistic. And as a result, I expect continued volatility in the equity market with a bias toward more downside than upside. And so this strategy is conservatively positioned. You'll notice on the upper left-hand side in the characteristics portion of this slide that the beta of the portfolio is less than 0.8 versus the S&P 500, which means that if volatility comes, my expectation is that this strategy will be less volatile than the S&P 500, which I think will prove to be an attractive characteristic. In addition, as we discussed on the previous slide, I do see an increasingly broad swath of stocks that are becoming really attractive from a risk reward standpoint as investors pile into these few large cap and increasingly very expensive growth stocks. And so I have a large position in Treasury bills. It's 11% of the strategy. Those Treasury bills currently are paying 5%, over 5%. And so that money is earning a return. And I anticipate over the next 6 to 12 months, a lot of really attractive investment opportunities to become available. Now, I know for a lot of people, there's a lot of uncertainty in the economy. There's a lot of uncertainty geopolitically, and that can be unsettling. But I want to remind you that this kind of volatility is when the best investment opportunities come about. And so this strategy is both currently positioned to be less volatile when that volatility comes to fruition. And this strategy is currently very conservatively positioned with a large allocation to cash and cash equivalents that are earning an attractive return, but that can be quickly sold and that money put to work as those really attractive investment opportunities that will drive really attractive performance in the 1, 2, and 3 year time periods ahead as those opportunities come to fruition. So with that as a close, as we approach the end of 2023, I want to take this opportunity to wish you and your families and your friends a hopefully restful as well as a joyful holiday season. And I appreciate your attention and your investment in the Waterfront Equity strategy. Thank you.